Did you know that most people are paying 5 times more for a financial product that delivers half the results? And the worst part is, banks love that you don't know this. In the next 30 minutes, I am going to show you exactly where your money is leaking and how to stop it now. Look, I know what you're thinking. Here comes another boring video about investing with a bunch of technical terms I won't understand at all. But relax. Today you're going to understand once and for all the real difference between ETF, index funds, mutual funds, and hedge funds. And most importantly, you will know exactly which of these products makes sense for your budget, your profile, and your goals. No beating around the bush, no banking nonsense, none of that consultant talk trying to push the product that pays the highest commission. By the end of this video, you'll have such a clear understanding of this subject that you'll be angry at yourself for taking so long to grasp it. Ready? Then come with me. Let me tell you a true story. In 2019, I was talking to a friend who had just received an inheritance of 200,000 reais. He went to his bank, that big, traditional bank that everyone knows, and the manager, who was super friendly, offered an exclusive investment fund for special clients. Management fee, only 2.5% per year. Performance fee, 20% on returns, exceeding the CDI Brazilian interbank deposit rate. My friend thought he was killing it, that he was a VIP, that he had joined the rich people's club. 5 years later, guess what happened? His fund yielded less than an index ETF that charges 0.2% per year, much less. We're talking about a difference of more than 50,000 reais. 50,000. That would be enough to buy a used car or take an incredible trip. And do you know what the manager's excuse was? Oh, but the market was tough. Management is proactive. We tried to protect your assets. ... double quotes. That's a lie. The truth is that the fees ate up the returns. This story repeats itself every day with thousands of Brazilians. And the problem isn't a lack of money to invest. The problem is a lack of clear information about where to put that money. So today, we're going to clear up this confusion once and for all. And I promise, you'll leave here knowing more about investment funds than 95% of the people you know. Before we delve into the differences, I need you to understand one fundamental thing. All of these products, ETFs, index funds, mutual funds, and hedge funds are ways for you to pool your money with other people's money to invest in a lot of assets at once. It's like an investment consortium. Instead of having to buy stock by stock, bond by bond, you buy a share of this fund, and that's it. You own a little piece of everything that's in there.
Okay, but then what's the difference?
My friend, this is where things get interesting. The first major division is this: passive management versus active management. Passive management is when the fund simply replicates an index. For example, the Ibovespa has the most traded stocks on the Brazilian stock exchange, right? A passively managed fund will buy those same stocks in the same proportion. That's it. There's no manager trying to beat the market, no betting, no elaborate strategy. It just follows the index. Active management is when a manager or a team of managers analyzes the market, selects assets, and tries to outperform the benchmark index. It's like having a football coach, assembling the team and deciding on the strategy. It can work very well, or very badly. And here's the first secret nobody tells you. The vast majority of actively managed funds do not beat the index in the long run. This isn't just my opinion. Decades of international studies have proven it. In the United States, for example, more than 90% of actively managed funds underperform the S&P 500 over 15-year periods. 90%, and in Brazil. The story is similar. Most multi-market funds, which are actively managed, fail to deliver returns higher than the CDI Brazilian interbank deposit rate after deducting fees. So why on earth do people still invest in actively managed funds? 2 reasons: illusion and marketing. The illusion is believing that this time it will be different, that this manager is special, that this fund has a secret strategy, and banking marketing is very good at selling this illusion. But hold on, I'm not saying that all actively managed funds are bad. There are excellent managers, funds that truly deliver value. The problem is that they are rare, difficult to identify, and expensive. Now let's talk about the first product, ETFs, or exchange-traded funds. The great thing about ETFs is that they work exactly like stocks. You buy and sell them on the stock exchange, in real time, at the price that's being traded at that moment. Most ETFs are passively managed. They replicate indices. Want to invest in the entire Ibovespa? BBOBA11 want to invest in the 500 largest American companies. Buy IVVB11, which replicates the S&P 500. Want exposure to gold? There's a gold ETF want to invest in cryptocurrencies without buying Bitcoin directly. There's an ETF for that too. And here's the magic of ETFs. The fees are ridiculously low. We're talking 0.1% to 0.5% per year in most cases. Compare that to the 2%, 3%, or even 4% that some actively managed funds charge. Let's do a quick calculation here, because numbers don't lie. Imagine you have 100,000 reais to invest for 20 years. If you put that in an ETF that charges 0.2% per year and the market yields 10% per year on average, you will have approximately 650,000 reais at the end. Now, if you invest in a fund that charges 2.5% per year, with the same return as the market of 10% per year, you will have approximately 490,000 reais. The difference, 160,000 reais, just because of the fee. And there's more. With ETFs, you have total transparency. Every day you know exactly what's inside the fund, because it only replicates a public index. There are no surprises. No black box. Oh, and one more thing. ETFs don't have withholding tax. You know that tax that traditional funds pay semi-annually, which reduces the value of your shares? ETFs only pay tax when you sell. This makes a huge difference in the long run, but it's not all roses. ETFs have some pitfalls. First, you need to have an account with a brokerage firm and trade on the stock exchange. For those who have never dealt with this before, it may seem complicated at first. But honestly, it's easier than ordering food on iFood. Second, you pay brokerage fees to buy and sell. Some brokers charge, others don't. But if you're making long-term investments, this is irrelevant. Third, ETFs have a feature called tracking error, which is the difference between the fund's performance and the performance of the index it is supposed to replicate. It's usually small, but it exists. And lastly, liquidity. Some ETFs are not heavily traded on the Brazilian market, so you may not be able to buy or sell them whenever you want at a fair price. But this only happens with more exotic ETFs. Demand ones such as BOV, A11, and VB11 have excellent liquidity. Now let's talk about traditional index funds, those that are not traded on the stock exchange. These funds are also passively managed and replicate indices, exactly like each. The difference lies in the way they are bought and sold. With a traditional index fund, you don't trade on the stock exchange. You invest directly through the banks or brokerages platform, and redemptions are also done there. It usually takes 1 or 2 business days for the money to arrive in your account. The fees are slightly higher than those of ETFs, generally between 0.3% and 1% per year, but still much cheaper than actively managed funds. And here's the big advantage for some people: simplicity. You don't need to understand the stock market. You don't need to choose the right time to buy. You don't have to worry about market prices. Just invest, and you're done. Oh, and one more thing. Traditional index funds allow for automatic investment. You can schedule it to be deducted from your salary every month, like a recurring investment. With ETFs, you have to do this manually. Do you want to enter the crypto world, but are holding back because you're afraid of making mistakes, falling for scams, or simply not knowing where to start? In the Crypto Masterclass Crypto Crew to 1, you'll have a clear path, with 16 video modules covering everything from Bitcoin and altcoins to wallets hot cold, exchanges, NFTs, interest rates, trading, mindset, and profit-taking strategy. Cash out everything to help you gain confidence and build a strategy. Secure your spot. Link in the description. But there are disadvantages too. The main one, withholding tax. These funds pay tax semi-annually in May and November, and this erodes your shares over time. So, in summary, if you want maximum convenience and don't mind paying a little extra in fees, a traditional index fund might be a good option. But if you want to maximize your gains, an ETF is still superior. Now, we enter more confusing territory. Mutual funds, also known as traditional investment funds. These funds can be either passively or actively managed, but most are actively managed. They have a manager making decisions, developing strategies, and trying to beat the market. And this is where things get dangerous for the unwary investor. First, the fees. Mutual funds may charge management fee, generally between 1.5% and 3% per year, but it can be much higher. Performance fee, typically 20% of the amount exceeding a benchmark index, such as the seed. Entry fee. Some funds charge when you apply. Ridiculous, but it exists. Exit fee. Some charge you when you redeem. Even more ridiculous. Oh, and there's also the cum codas tax, so the tax will erode your income every 6 months. Now, let's be fair. There are excellent mutual funds, managers who truly add value, who have differentiated strategies, who are able to navigate crises and seize opportunities. The problem is that these funds are rare, and even when you find a good one, it probably only accepts qualified investors with a minimum investment of 500,000 reais or more. For the average investor, what's left? Most often, mediocre funds with high fees. And there's another problem. Lack of transparency. Many funds don't disclose in detail where they are investing. You know it's a multi-market fund, but you don't know exactly which stocks, bonds, or derivatives are in it. This means you are blindly trusting the manager. What if the manager is wrong? What if they make risky bets? You'll only find out when it's too late. Now, let me tell you an industry secret. Banks love selling mutual funds. Do you know why? Because they pay hefty commissions to the managers. That friendly manager who offers you an exclusive fund is you aren't necessarily thinking about your best interests. He's thinking about his commission, and it's not his fault. That's just how the system works. So, when does it make sense to invest in an actively managed mutual fund? First situation, when you don't have the time or knowledge to build your own portfolio, and you're willing to pay for professional management. Second scenario, when you've found a manager with a consistent history of superior performance, and the fees are reasonable. Third situation, when you want exposure to complex strategies that would be difficult or impossible to replicate on your own, such as arbitrage funds or long and short strategies. Aside from those cases, honestly, you're probably better off with ETFs or index funds. And finally, we arrive at hedge funds, the elite of investments. First, let's clarify. In Brazil, we call any sophisticated fund a hedge fund, but technically most are multi-market funds or exclusive funds. The term hedge fund comes from the American market, but regardless of the name, the idea is the same. These are funds with advanced strategies that use leverage, derivatives, short positions, arbitrage, and other complex techniques to seek superior returns. These funds are generally for qualified or professional investors. The minimum investment, it could be 500,000, 1 million, 5 million. It's not for just anyone. The fees, they usually follow the 2 and 20 model, a 2% administration fee and a 20% performance fee. Some are even higher. It seems absurd, right? And it is absurd. ... Unless the fund actually delivers returns. MUCH higher than the market. The great appeal of hedge funds is the possibility of making money regardless of market direction. While ETFs and passive funds will rise when the market rises and fall, when the market falls, a good hedge fund can profit from both rising and falling markets. How? By using strategies such as long and short. Buy stocks that you think will go up and sell. Short stocks that you think will go down. Arbitrage. They exploit price differences between related markets or assets. Global macro. They make bets based on global macroeconomic movements, currencies, interest rates, commodities. Event-driven. They focused on corporate events such as mergers, acquisitions, and restructurings. It seems incredible, and it might be, but there's a huge but. Most hedge funds also fail to consistently beat the market in the long run. That's right. Even with all that sophistication, brilliant teams of analysts, and cutting-edge technology, most don't deliver. And when they do deliver, the extra return is often eaten up by the exorbitant fees. There are exceptions, of course. Legendary fund managers like Ray Dalio, David Tepper, Paul Tudor Jones. These guys really manage to get absurd returns. But good luck trying to invest in their funds. They're so selective that you need to be introduced by someone, have tens of millions to invest, and even then you might end up on a waiting list. For the average investor, hedge funds are basically unattainable. And even if you manage to gain access to one, you need to ask yourself, are these fees really worth it? Or would you be better off with a diversified portfolio of ETFs? In most cases, the honest answer is the second option. So, let's recap everything here in a clear and objective way. Asterisk, asterisk, ETFs. Asterisk, asterisk, passive management. Very low fees, 0.1% to 0.5%. Total transparency, no withholding taxes. Traded on the stock exchange. High liquidity in the main funds. Ideal for most investors. Asterisk, asterisk, traditional index funds. Asterisk, asterisk, passive management. Low to moderate fees, 0.3% to 1%. Ease of investment, automatic investment available, but subject to withholding taxes. GOOD. For those who want maximum simplicity. Mutual funds. Active management. Average to high fees, 1.5% to 3% plus. Attempt to beat the market. Most fail. Less transparency. Subject to withholding tax. USEFUL. In specific cases, with exceptional managers. Hedge funds. Ultra-active management. Very high fees. 2%. Plus 20%. Sophisticated strategies. Very high minimum investment. Restricted access. For professional and ultra-wealthy investors. Do you want to enter the crypto world, but are holding back because you're afraid of making mistakes, falling for scams, or simply not knowing where to start? In the Crypto Masterclass, Crypto Crew 2.1, you'll have a clear path. With 16 video modules covering everything from Bitcoin and altcoins to wallets hot-cold, exchanges, NFTs, DeFi, interest rates, trading, mindset, and profit-taking strategy. Cash out everything to help you gain confidence and build a strategy. Secure your spot. Link in the description. And here's my honest recommendation for 95% of people. Start with build a diversified portfolio with ETFs that track broad indices. Above S&P 500, maybe some fixed income or international ones. And you're all set. You'll have exposure to the global market with minimal costs, complete transparency, and simplicity. If you have more money, more sophistication, and want to pursue active strategies, then yes, consider mutual funds or hedge funds. But do your homework. Analyze the history. Understand the fees. Question everything. And never invest in something just because the bank manager said it's good. Bank managers work for the bank, not for you. Look, I know that was a lot of information, but the good news is that now you're armed with knowledge that most people will never have. You understand the difference between passive and active management. You know how much fees impact your long-term returns. You know that ETFs are, for most people, the best option available. And most importantly, you know you don't need complex, expensive, and exclusive products to build wealth. Simplicity, consistency, and low fees win in the long run. So here, that's your homework. Open an account with a brokerage firm if you do you and already have one. Research ETFs available on the Brazilian market. Put together a simple allocation strategy. It doesn't need to be perfect, it just needs to get started and start investing. And if you enjoyed this video, if it truly added value for you, leave a like. Share it with that friend who's lost when it comes to investing. And subscribe to the channel because there's much more content like this coming soon. Oh, and leave a comment. Do you already invest in ETFs, or are you in some mutual fund that charges absurd fees? I want to hear your story. And remember, your money is yours. You worked hard for it. So don't let exorbitant fees and mediocre managers eat away at your earnings. Invest wisely. Until the next video.